Welcome to the daily update, where I'll go over the action in the market for Friday, April 4th, and we'll see how things look for Monday, April 7th. Well, if you thought Thursday was ugly, boy, oh boy, Friday was even uglier. You've got a lot of panic happening right now. The market was already extreme negative as far as sentiment. Now it's even more so. And is this some kind of a washout? Have we seen that? Or is this just getting started with something that's going to see even more declines? We've got a tremendous amount of technical damage. Everything is pretty much looking negative now, including our smart money indicators, which we've been getting mixed signals for a while now. So we're seeing money actually coming out of the market at this point. And it was quite negative right from the beginning. We saw pretty much the same type of open on Friday that we saw on Thursday. The futures were lower, down about 3% or so. We gapped lower and just kept going. Any attempts to buy the dip were quickly met with more selling, and we closed pretty much at the low for the day. All right, so right at the open, we had a huge gap lower open again below S2 at 53.20. We're just counting down the hundreds here. Just, middle of February, we're up into the 6,000s. And now we're coming down to the 53.20 and going even lower. We went down below S3, had to pull out the pivot point calculator again at 52.12. We tried to bounce a few times, but it was really just slow. It slowed things down for a little bit. And we fell down to S4 at 5103. Then we tried to stabilize around S4. There wasn't really any significant bounce. We tried to go up a little bit, would go down, go up, go down, and we closed at the intraday low below 5100. So we're just ticking down lower right now with these 100 levels in the S&P. We were down 5.97%, almost 6% in one day. Now, we had almost a 5% decline on Thursday, almost another 6% on Friday. That's 11%-ish or around in there. That's a pretty severe decline just in 2 days. And it's all about the tariffs. And there's likely some overreaction, but the market tends to do that. And we were well above average with volume. We are negative in the short and intermediate term. We're hanging on to the long-term trend being positive, but the longer we stay below this 200-day moving average, the more we might see a crossover pretty soon and actually change the long-term trend to negative. And interest rates, it's another day of flight to safety, coming out of stocks, going into bonds. So we're seeing interest rates really drop right now. We're getting under that 4% level with the 10-year yield. And we did have an employment situation report that looked pretty solid, but the going back over the last couple of months, they've revised those numbers down. Now, one thing that's kind of floating around out there with some of the information sources that I use, and I've mentioned this before, I don't consult a lot of information sources because I mainly get everything from what I see myself, and I've been doing this for so long, I don't really need to get things, but you like to listen to other people. You get some different perspectives at times. But there is speculation out there that the economic reports were propped up before the election. Now that the election is over, they're revising numbers down from before and making things look worse than they really are, or actually making them more like reality, where things weren't as positive before the election. That's pure speculation. I don't have any inside sources on that, but some people that I pay attention to, they've been mentioning that on a fairly regular basis, and they do have people that they really know that can understand better what's actually happening there. Regardless, the market still trades off the data that it's given, and even though lately it's been pure emotion due to these tariffs, the numbers are holding up for right now. We're going to be looking because there's this fear of going into a recession. And as long as the employment area stays strong, then that's a good thing. If that really starts to fall apart, then that could turn things even more negative. Okay, some comments. The Nasdaq was down 5.8%, and now it's in bear market territory. It's now declined 20% from its peak back in February. When you decline 20% or more, it's now considered a bear market, no matter where the moving averages are lining up. And then China retaliated against the US tariffs. They said, okay, US, we're going to put a 34% tariff on things that we import from you. The only thing that's a little bit of an overreaction there is China doesn't buy much stuff from us. We buy stuff from China. So is this really going to have much of an impact? But this is heightening the trade war and tempering hopes that these tensions may ease soon. There's also global slowdown where the whole world just declined in Friday's market. So we're seeing weakness everywhere right now. And so these worries are getting more intense, and this is leading to what's called a risk off bias, meaning get out of stocks, go into bonds. And that's what we're seeing. Interest rates are coming down, people are getting out of stocks, getting into bonds. And we finally saw some money actually coming out of the market. We've been watching this for the last number of weeks, pretty much for all of 2025, this rotation, I should say, since about the middle of February, this rotation from growth over to value. Well, now we're even seeing that money being pulled out, at least in Friday's session. So then the non-farm payrolls, that's what NFP stands for, showed growth, but the previous numbers ended up being revised down. I'll go through those numbers here on the next slide. Then Fed Chair Powell also gave a speech, and he's like, I'm not too concerned with all this volatility going on. He said, yeah, the tariff increases are larger than expected, which will provide some headwinds for the economy and for growth. But he also said that the FOMC will patiently wait for greater clarity before making any adjustments to policy. And again, some of the folks that have they make some comments about what's going on. They're kind of putting the Fed on the back burner now. A lot of this is dealing with the change in the administration, and there's like a whole overhaul of the way the U.S. has been doing things over the last 100+ years, and it's going to produce some real instability and real uncertainty, like what we're seeing right now. It's kind of like if you have a house, do you rebuild it? Just add on a room or change the carpet or something. That's kind of what's been happening for the last 100 years or so. Well, now it's like, well, let's just burn the house down and then rebuild from the ground up and start with something that's new and that's fresh. And that's an oversimplified way of stating things, but that's kind of a couple of the camps. See, folks for a long time have been, okay, things go down, the Fed steps in, something happens, there's quantitative easing, and magically the markets go back up. That doesn't seem to be in play this time. And if you grew up in the mid to late 60s and early 70s, like I did in the Seattle area, it was when Boeing, the company, of course, they're going through problems now, but this is when they were the major aircraft company. But we went through such a difficult time. Everybody was leaving Seattle, and there was a sign that said, would the last person leaving please turn off the lights? I mean, and I was talking to my dad about that, and he said, that's one of the best things that ever happened to Boeing. Boeing is what brought my family out to the West Coast. He said, you clear out all this dead wood, you reset everything. Yeah, it produces a lot of pain, and people really have to adjust their lives. But it gets to the point where, okay, all the garbage is gone, and now we can start rebuilding things again the right way because a lot of the policies and attitudes it goes back to the end of World War II. Well, we're getting further and further away from World War II, and the world has changed so much, and so possibly there's, at least according to the new administration, it's like, okay, let's change things. Let's do things more from a business angle rather than being the safety net for anything that goes wrong, meaning that, okay, when bad things happen, we just have to take responsibility for that and then rebuild. And I know that that's not a pleasant thing. If you think back to the 1987 crash, what did Ronald Reagan do after we had that big crash? absolutely nothing. He says, hey, laissez-faire, government stays out. This is capitalism. I'm not going to step in there and rescue people that have been acting in a very dangerous way. Just let the markets work it out. And when you let capitalism work in that kind of a way, it has a way of producing its own efficiency. Now, there's people that disagree with that and think that there's this crony capitalism, which does exist, and that there are better ways of doing it, which is switching over to more of a government control type of scenario, which is really where the US had been heading. And now we're trying to head back over to say, okay, let the markets decide what things should be valued and what the efficiency should be. So this is an ongoing scenario, and it's a real paradigm shift from the way things have been going for a long time. And the market's really feeling the pain of all that. We're above 40 with the VIX. Yeah, okay. We get nervous when it goes above 20. Now, and then after Thursday, we were above 30. Now we're above 40. We closed at 45.31. That's a really high reading there. A very long list with those extreme negative short-term indicators. Doesn't necessarily mean that we're at a bottom, but it just means that we're seeing more of a capitulation type of an approach that's happening right now. Even the ADX, the red line, both on the short-term chart and the intermediate term chart, it's well above 40 now. It just shot up like crazy. We're extreme with the 20 period exponential moving average. That's short term on the S&P. The VIX has just been screaming to the moon, so the speed is really pretty quick there. And we have the rate of change going back 5 days, 10 days, and 20 days. Those are all extreme negative. And then we have our usual indicators that if we're going up or down, that tends to either confirm that we're looking more positive or negative, or it can also mean we're overextended to the upside. That includes the Stochc RSI, Williams percent R, CCI 1420 stochastics. Those are the usual charts that we see. The force index kind of comes and goes, but it is like massively negative right now. We're far underneath the 20 period moving average, and this was already on the list, the short-term RSI. And we also have a really long list. Now, just 2 days ago, we had no list at all. And this all developed in Thursday and Friday's session. So here's the intermediate term ADX, and I'll show you charts of all these things here. The 50 period moving average, which is what I use for the intermediate term, we're way down in the -3 channel with the standard deviations chart, the Connors RSI, the rate of change going back 50 periods. So short-term rate of change charts are extreme negative. We have intermediate term charts that are extreme negative. The Arun, which was really the only thing on the list lately, that's extreme negative. And then we have the PMO itself, as well as some of the studies that we look at of PMOs inside the S&P 500, the Sean Trend Meter, the Bullish Percent Index, all three that we follow. The S&P, NYSE, and NASDAQ 100 Bullish Percent Indexes are all extreme negative. For 2 days now, we are extreme negative with the percent B. We continue to close down below the lower Bollinger Band. And then we're far away from the 50 period moving average. And now the intermediate term RSI has become extreme negative. And then even in the long term, we're getting extreme with the 150 and 200 period moving averages. Okay, so really not concerned all that much with the Fed. Now, in the upcoming week, the meeting minutes are going to be released. So we'll see if that sheds any light as to what's actually happening and what the Fed is actually talking about with all these changes that are taking place. The dollar was down and interest rates were down. We actually got under the 4% level there for a while, but we ended up closing at 4.06%, where we had been at 4.2%. And this is a flight to safety coming out of stocks, going into bonds. That's pushing bond prices up, interest rates down. At some point, this may produce a type of an environment where interest rates are low, so that could help the small caps and the mid caps and all these companies that have to borrow money. And that could start to at least produce a scenario where earnings going forward might start to look better again because the interest rates are lower for what they have to borrow. And that might bring some folks back into the stock market. We're not really sure when that's going to happen. We're just watching that to see it unfold. And we're down at 8. My goodness. Single digits now as far as sentiment. We were already negative at 17. Now we're down to 8. And we're still inverted with the 10 to the 3 month yield curve. The 10 to the 2 year, that's not inverted yet. We're watching this one instead. And we're negative with our trend. The ADX is above its moving average going up. As I said, the red line is really high, above 40, both on the short and intermediate term chart. And of course, the bias is negative with the massive down day and our momentum. That's the last 2, 3, 4, 5 days taken together. That is negative as well. Okay, we did get, probably the most important economic report of the month, but okay. However, the market wanted to choose to look at this, they chose to look at it in a negative way, even though the numbers are high. They expected 130,000 to come out for new jobs. It came in at 228,000. That's really strong. But what concerned the market is last month when we had this report, it was first reported that there were 151,000 new jobs. They revised that down to 117. And so the market went, uh-oh, we don't like that. I don't have the numbers for the month before that, but the revision down is rather significant. And then non-farm private payrolls also a lot stronger than expected, but those numbers were also revised down as well. We ended up getting 209,000, much more than the 120,000 that was expected. And the first time we had the report, it was 140,000. Then it was revised to 116,000. Average hourly earnings came in as expected, up 0.3%. This was actually revised to 0.2%, where it had been at 0.3% in the previous reading. Unemployment rate did tick up, so we have pretty solid numbers. But as I mentioned a few decades ago, they changed how this whole unemployment rate was calculated because this is one number that politicians and folks can point to get an idea of what is the job market like right now. And there's a lot of manipulation that goes into this number, and it ticked up to 4.2. They expected it to remain at 4.1, which is what we saw last time. The average work week came in as expected, 34.2 hours, much underneath the 40 hours a week, which is a full-time job. And it got revised up to 34.2, where the initial reading was 34.1. Okay, so here's the hourly earnings. I don't look at the job numbers charts. There's some variations that I do look at, but you go back to COVID and that chart is so skewed, it's pretty much useless. But we're coming in, actually dropping just a little bit with wages on a year-over-year basis, a little bit under 4% growth. This is what I do show here is just the change that we see where it really shot up, but the previous ones reports were actually revised down, and that concerned the market. So the unemployment rate is now at 4.2%. To put that in context with the initial jobless claims that we get on Thursday, which have been declining, and that's more real time. That's closer to what's happening right now, where the employment report is still looking back further. That's why I really pay attention to these. We are seeing a bit of an increase in the continuing claims, but now the unemployment rate is starting to tick up. But we've been here before recently. It's not a real high unemployment rate, but we'll be watching that. Okay, then this just goes hand in hand from real investment advice where earnings are what ultimately drives stock prices. The blue area here is where we're seeing the year over year change with earnings per share. And that's why we're not really going up. It's not going down, but it's not really going up. And the market's concerned about that. They want this blue area to keep going up here, and that justifies stock prices going up as well. It also helps to adjust the PE ratios, the price to earnings ratios that we keep an eye on. And volatility is the toll we pay to invest. Okay, we're coming down here to have a 3%, 5% dip. Okay, correction, that's when things get a little bit more severe. We're getting close to that 20%. Now, the NASDAQ is already in a bear market. We're about 17% in change right now with the S&P. And even though that doesn't happen very much, it's it's something that does happen. It's just a reality of the markets. Now, the perma bears, they're partying. This is like Christmas Fourth of July, birthdays all kind of rolled into one. Because they're wrong 70% of the time. This is the 30% of the time that they're actually looking to be right. And then this just shows the buybacks. Now, in yesterday's video, I mentioned that we're getting ready for earnings season to come out. And when companies have to report, there's a blackout period. They can't come in and announce buying back any of their shares because that tends to be positive for the stock price. And so they just decided you can't do any of that while you're coming up close to reporting your earnings. And so that might skew this a little bit, but it just says the announced buybacks are the lowest dollar volume since quite a while here. And but again, some of that can go back to the idea that these companies are on blackout. And then share of sales derived from outside the US, you've got almost half of the sales that the Magnificent Seven make are out of the US. And so these tariffs are going to have an impact on these companies. And then the NASDAQ 100, also very high. The Russell 2000, these are the small caps and the mid caps. They're more domestically focused. And then you've got the rest of the S&P and then the S&P itself, which again, a quarter of that. It's mainly the big Magnificent Seven stocks because they do so much international business. And then these are earnings per share revisions since the start of the year. You can see for the most part, these lines are going down. They're still positive, but this is negative because those revisions are going to the downside. Looking at the Magnificent Seven, they've been coming down as well. And so this going back to pretty much the beginning of 2025, this is when and even into December 2024, we started to see the market really turn more sluggish. It did set an all-time high in December and then again in February, but there wasn't an awful lot of conviction behind that. And looking at the VIX, this is the fear gauge. And really, if you're not used to reading any of these charts, I went ahead and included the explanation. And now this was before Friday's session. It says market participants are anticipating a potential decline in volatility. That would be stocks going up, reflecting hopes for reduced uncertainty and stabilization of trade-related concerns impacting the markets. And that's what we're seeing here with this. This is the curve here for the VIX because there's also futures contracts that trade on the VIX. We mainly follow the day in and day out numbers here, but this is just showing an overall decline in volatility, which would be positive for stocks. Not really seeing that much after Friday, though. And then we're back in correction territory. We're down over 10%, and we've now dropped 12%. But this is after Thursday. We dropped another 5% on Friday. So we're getting into that 17, 18% correction level now. Then this is kind of interesting, though, and that's why it may be overblown with the markets freaking out about these comeback tariffs that China's now putting on the US. Well, it's like, is it really that big of a deal? Look at the red line. These are things that we buy from China. We don't buy an awful lot from them. We get a lot more from Germany and from the imports from the EU taking out Germany. So it's not like we sell a lot of things to China in the first place. So is that going to be a real big deal? It could be because, like I showed earlier, the Magnificent Seven stocks, they do a lot of international business, almost half of it. And so that could have more of an impact here. But when you just look at this red line, it's like, okay, we buy a lot more from them than they buy from us. And a lot of trading volume. We'd been below average with volume for quite a while, and then things started to get all shook up, and we're seeing just a massive increase across all the different exchanges. I mainly follow the volume just for the S&P itself, but this includes all of the different markets. And then what happens when the VIX gets over 45? Here's some statistics here, because that's where we're at now. A week later, we're up 83% of the time, and then with a return of 4.3%, the mean and median anywhere between 3.6 and 4.3%. And then 2 weeks out, we're up 70% of the time, and then back to looking a little stronger a month out, 83% of the time. 2 months later, we take a bit of a rest. But you can see for the most part, the percentage of us being positive looking out into the future is pretty high at this point. But we don't know how much more there is to go. A lot of folks thought the big decline was on Thursday and we might get some kind of a bounce on Friday, not decline another 5% with the S&P. Okay, so here's the chart in the big gap lower on Thursday, and then we just kept going down. We closed at the low. Kind of a repetition of Thursday happened on Friday. You can see these bars along the bottom, much higher than usual, way above average. But we declined down below S2. We got down below S3, tried to bounce up a couple of times, made it down to S4, tried to bounce from there, came back down to S4, tried to bounce near the end of the day, then ended up closing right at the low. So two pretty significant down days with the market closing right at the intraday low. So we're going down here. This just shows the fall off that's been happening. And some of this has been happening before the market even opens while the futures are trading. And then it just carries over into the cash session throughout the day. This could end up being positive, even though these are on different scales. The red line and the blue line, they're all getting hit right now. But these two lines are getting a little closer to each other. So value's getting taken out and shot just like growth has been as well. And not much of a change here. Actually, a tiny bit of an improvement with the S&P growth to value ratio, but it was still negative on the day. So growth was down over 6%. Value was down 5.75%. I mean, everything got sold on Friday. And sometimes that can mark some kind of a capitulation, a washout, where everybody's like, forget it. I don't care what the price is. Just get me out of this market. Where growth was down more with the mid caps and actually down less with the small caps. I have to take a drink. Um, Sorry about that. You got to love these take one videos here, but my throat was just getting really dry. So not really much of an improvement with the growth to value ratios with the small caps. Still below the 200-day moving average, going down below the 200-day moving average with mid cap growth to value, looking even worse now with S&P growth to value, and we're getting ready to see a death cross here with this ratio. Seeing more damage done here with this growth to value ratio as we're falling further below the rainbow. And discretionary, it ticked up just a little bit. It actually held up a little bit better. But overall, this ratio has been really weak. In a positive environment, we would see this ratio going up. And really picked up here with the ADX. This is the intermediate term trend. Now, we're not above 40 with the ADX itself, but we are above the moving average and going up. That means the trend is now getting stronger again. It's the red line here that's really going up above this 40 level. And the last time we were above this 40 level, this was the end of the world day last summer. But again, the context was different at that point. There was another administration. There were other rules that were being implemented. Well, now we're seeing a lot of this upheaval because of change that's happening. But this is just showing that maybe the selling has gotten a little out of hand. And we're seeing that in the short-term chart too, with the red line above the 40 level, even above where it was back in August when we had that big down day. Volume has been really picking up. You can see the last 2 days, these are green with the histogram here. And we've been quite, folks are noticing what's going on, and there's a lot of volume taking place. We're really shooting up here with the ulcer index. That's one fear gauge that we look at. We're really going up with the VIX. We're getting up into the mid 40s now. That's even higher than the closing that we saw last August. We got up to about 65, I think it was, on that day on an intraday basis, but then ended up closing off of the high. Where in Friday session, we just kept going up. This is the bar chart, and we closed pretty much at the high, which also matches up with the line chart, which is just the closing value. And when the VIX is going up, the VIX of the VIX is also going up. So there's volatility of the VIX also increasing. And now for 2 days, we see the VIX as measured by the RSI 9 periods. We're well above the 70 level. So maybe we've overdone it a bit there. The momentum for the VIX is up. And this euphoria meter here, it's coming down, but I don't know. It's not coming down all that much. A lot of the other fear gauges that we're looking at are below zero and declining and actually starting to get extreme negative. And then this is another newer volatility measure that I've been looking at, the Landry volatility, where it's really spiking up. Now, this is more volatility just on the S&P. Now, the VIX is too, but this is just a little different way of looking at this from volatility. This is going up, that means the S&P is going down. And here's a fear gauge that continues to go up, and the other fear gauge really spiked up here. And I'll be going through a lot of the stocks to bonds and bonds to bond ratios over the weekend and the weekly videos to see, okay, what is changing as far as that environment is concerned. And we're seeing an increase here with the spread between risky and not as risky bonds. This is starting to go up. That means there's fear increasing in the bond market. And we look at this, the inverted version of that chart I just showed, with this continuing to go down, that means that fear is going up. And that's negative for the market. And again, just to give a little bit of a comparison, this is how far we fell last August, and then we bounced here. We're now showing more fear now than we were back last summer. Okay, I didn't update these. I wanted to get this video recorded and posted as soon as possible, and I have to wait for this data. Sometimes I'm ready to record 2 or 3 hours before these charts even update. So we haven't been getting an awful lot of insight with the equity put call studies that we do here. You can probably guess that they're all going up, which is more negative, both the 5-day and the 10-day chart. This is negative as well. We're still coming down with the risk on to risk off ratio. Folks are getting out of the high flying stocks and getting more into the more conservative stocks that tend to hold up better when the market's going down. And then we look at inflation expectations to tips. This shows that inflation expectations are actually underperforming tips. And I'll go through this chart again over the weekend, but we're actually seeing inflation expectations coming down. And then high beta, the Apple, Amazon, Netflix, Google, and then comparing it to low beta stocks, the real boring companies that just kind of they don't really go up in price, they don't really go down in price. Well, this ratio going down is more negative for the market. But we're still getting quite a low reading here with the volatility risk premium, projecting fear out. The VIX does that as well, but this is just another way of measuring this, that it's not really showing a lot of fear at this point. Now we're finally seeing a little bit of weakness here with the advanced decline line. We came down based on price, but not really weak. But we saw a lot of selling, and so we're actually dropping below the moving average now based on volume. Haven't seen that yet. And this is holding up too. The advanced decliners over the last 10 days were negative, but we're not too far underneath the zero level. And we're seeing a real deterioration here internally. We look at this massive number of new lows that were generated, had a few new highs, but this big red bar coming down, that's kind of scary. So we're going down with the 5-day and the 10-day moving averages of the highs minus the lows. We're dropping below zero with our advanced decline ratios, both in the short and intermediate term. And we're finally dropping below the moving average with accumulation distribution. This was just hanging out above the moving average, suggesting there was rotation going on. When we actually drop below the red line, that means there's selling going on. That money's actually coming out of the market. And we're negative here with the chicken money flow. We dropped all the way down with the histogram turning red and the red lines going down. And we're declining below the midpoint with the chicken oscillator. So we're seeing all three of our smart money indicators now negative. The vortex, which spent one day being positive, Wednesday, well, it switched back to being negative after Thursday and is even more negative after Friday. And I haven't shown a lot of the advanced decline line studies here because we've been just kind of chopping along sideways. This is the S&P. And this is what's made it more difficult to try to evaluate things because this is being caused more by rotation, where we looked at the cumulative advanced decline line for the S&P based on price. Not much damage there, but we did see more damage done based on volume. And then comparing the S&P with the NYSE advanced decline line, this is not an apples to apples comparison. It's more you have one index and then another market, and you're just seeing how they're interacting with each other. where the red line's actually been holding up a little bit better as we see the bar chart here really going down. And then the cumulative advanced decline line for the NYSE really dropping off, looking negative, falling below the moving average and declining here. Not an awful lot of damage to this point. We're just coming back down to these previous lows that were set at the end of 2024, but it is weakness nonetheless. Also, looking at this other NYSE advanced decline line dropping below its 200-day moving average. And then we break it out based on common stock. Not as much damage based on price, more damage here based on volume. And we're below the moving averages now with all our indexes, with the advanced decline line studies. Declining with the NYSE common stock. We're showing more weakness now with the S&P. We've already been showing weakness with the mid caps and the small caps. New highs, new lows. Haven't shown this for a while here. The black area that you see, that's the daily value. And then the red line that you see running through here, that's a 50-period moving average of the daily version of the new highs minus new lows, coming down and actually dropping below zero after getting a really negative reading for the day. And then a broad market measure of the 5-period moving average of the highs and lows. This has been declining, and that's more negative internally. Extreme negative with those stocks in the S&P above their 20-period moving average, and extreme negative with the 50-period moving average study, the 100-period moving average study, and the 200-period moving average study. So yeah, lots of damage done on Friday. And really coming down here with the daily chart, breaking through all kinds of support on a well above average volume. The 1-day rate of change. Now, Thursday was bad, but Friday was even worse, and that's why we saw this really going down as much as we did. Here's the 5-day rate of change, getting really extreme negative. And the last time we had a really low reading like this was at the end of the World Day that we had last summer. This is an even lower reading now. The rate of change going back 10 days, that's also very extreme negative, as is the 20-day. Now, the 5, 10, and 20, those are what I consider to be more short term. There'll be a 50 rate of change chart that I show in a minute. Now, this just goes day by day. The advanced decline line percent, extreme negative. And the advanced decline ratio, also extreme negative, meaning that we went down pretty far, pretty fast. It doesn't necessarily mean we'll bounce on Monday. It might mean that we're just going to slow down a bit. We'll have to see. There's 2 full days with anything able to happen that could happen over the weekend. We'll see how things open up with the futures Sunday afternoon or evening. And we're above this 10% level. We are now down 17.42% from the all-time high. If we go above 20%, that means we are now in a bear market. And here's also measuring on an intraday basis, 17.5% here. The intraday all-time high on February 19th, and then Friday's close. That's pretty significant. And we're getting extreme negative with the 20, 50, and not there yet with the 200-period moving average. But in the short and intermediate term, shows us going down pretty fast here. And we're extreme with the Stochk RSI, the Williams percent R, CCI 14 and 20. And the stochastics are extreme negative in the short term, just barely on the border here in the intermediate short term. Never really had much of a chance to go positive, and we're already extreme negative in the long short term stochastic chart. Here's the force index. It's like, okay, gravity still lives. It really came down quickly. The condition of the short term trend continues to deteriorate. And we're way down here. We're actually falling below this -3 standard deviations channel. So we went down pretty far, pretty fast. We're dropping below the midpoint with the balance of power. We're extreme negative with the Connors RSI. Lots of deep purple here. Highway Star. That was the other song I was trying to think of. So this chart is obviously negative here. Dropping below the lowest low value. We're just falling too fast here to keep up with these bands that are on the outside of price. And the condition of the intermediate term trend continues to deteriorate. We're falling below all kinds of support. We lost this pretty significant low set in October 2023. Well, now we're falling down even below this anchored moving average as well. The TTM squeeze finally went, wait a minute, I'm going up and the stock's going down or the market's going down. I better start going down too. And so this is now negative with a darker red reading here. Then here's the intermediate term, rate of change 50, very negative reading. We saw this way back in 2022 before, and that ended up leading to some kind of a bounce. But there's nothing to say this can't still go further to the downside. Moving really quickly according to standard deviation. We've been coming down really fast there. Getting quite extreme here with the ease of movement. I could have put that on the list. The Arun indicator is also extreme negative. We're below zero and declining with the S&P McClellan oscillator. So we're now going down based on price and volume. After Thursday, we were still going up based on price with the summation index. Below zero and declining with the NYSE McClellan oscillator. So we're declining with the summation index based on price and volume for the NYSE summation indexes. And we were getting a mixed picture here after Thursday. Now we're declining with the Swindler trading oscillator based on price. We're going down, not very much, but we are declining here based on volume. Momentum is now turned over negative and getting extreme negative when we get down below this green area. We were trying to improve. Now we're coming back down. And we're just coming back down to the moving average here based on price. We're seeing more weakness here based on volume. And we're getting extreme with the PMOs that are rising. It's below this red line. We're almost extreme negative with the buy signals, and we're continuing to decline with the PMOs that are above zero. And we're negative with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR. We're now negative with the slope oscillator. It's below its moving average and declining. And if we go below this red line, that means we're extreme negative already. The MACD, short to somewhat intermediate term, is now negative. So our oscillators are now rolling over. The slope and TSI, all three of our intermediate term indicators, were turning back negative with the tricks and just coming down to the moving average with the KST. The Copic curve has now turned negative by crossing below the red line. We're extreme negative with the Sean trend meter. We're below 50 and declining with the money flow as well as the ultimate oscillator. We're dropping below the moving average with unbalanced volume, so that's turning this more negative. We're below all the moving averages here, and we haven't even really made much of an attempt to get back up and see if these lines will act as overhead resistance. Declining and becoming extreme negative with the S&P bullish percent index, the NYSE bullish percent index, and the NASDAQ 100 bullish percent index. Look at that, very low reading here. Okay, and we're far away from the 20 period, 50 period moving averages. We're negative, but not far away from the 200, at least yet. And we're negative, extreme negative with the RSI 14 and the RSI 9. Here's the percent B indicator where we are extreme negative. And this is quite a low reading here. And we do have a buy signal generated by the mass index, but you might want to be careful with this. It'd be like stepping in front of a moving train and thinking that you have the ability to stop it. And we're also working off of a buy signal with the praying bottom fisher as well. Sorry, seem to have a real cotton mouth right now. We're losing all kinds of support levels. We fell under the 50% here. Now we're down, dropping below the 38.2% retracement. And that's going back to the low set a year ago, April. So just exactly almost a year ago there. This is a long-term fib chart. I brought this up thinking, oh, we got a few days. We won't get down here very quick. Nope. This goes back to the October 2022 low. That was the major low that the market set. Here is the high that was set in February. We're now falling below this 38.2% retracement level, and with a possibility of still going down to this 50% retracement level. We lost this support. We've been hanging on to it for the last few weeks, the weekly chart of the S&P, but we came right down to this S1 level, and maybe that'll end up providing some support. But this chart is seeing a lot of damage right now. Longer term, we're starting to drop underneath this trend line on the weekly chart of the S&P, going back to the 1987 crash. This is a further blow up of that same chart showing how we're breaking through long-term support. And we're coming down to the midpoint with the trend channel. I was pointing this out at the time. When we were going up in December and into January, we were hitting the upper end of this trend channel, and that was about the time we saw things really begin to calm down. Now we're coming back down to the midpoint. Well, this provides some kind of support. So negative with the Heiken Ashi, the Kegi chart, the Renko chart, the three-line break chart, and we're drawing more zeros in here with the point and figure chart. That's negative. We're actually breaking below this blue trend line, and we're seeing a descending triple bottom breakdown. Okay, long term, getting extreme negative with the 150 and 200 period moving average studies here. Negative across the board in the short and intermediate term with stocks, but we're still negative with the mid caps and small caps in the long term. And bonds are seeing a little bit of love these days, so they're positive in the short and intermediate term. Commodities are now looking more negative. They've been getting hit where this area had been stronger, and this was producing some of the inflation concerns, where the dollar is still negative in the short and intermediate term. All the sectors ended up being down, with energy being down the most. Tech got hit hard, down 6.59%. Communication was down 5.75%, and discretionary was down the least, but it was still down 4.33% here. Staples got everything got hit in Friday's session. Awful lot of red here. First, we had a discretionary BPI cross above 20, but then red for the rest of the day. And so pretty much anything that happened was negative in Friday's session. Really dropping off here when we compare the equal weight, which is in red. Even though it's holding up a little bit better, it didn't do better in Friday's session. You can see the bar chart here. That's the weighted version of the S&P. It actually held up just a little bit better. So we're coming down a little bit with the ratio between the weighted and equal weighted version of the S&P, but not a real big change there. And this is the equal weight version of the S&P compared to the S&P itself. When this is going up, which it has been doing lately, that means the equal weight version is outperforming. Seeing an awful lot of damage done here with the Dow falling well below these support levels. And we're negative with the Elder's impulse system. Lots of gaps in here. So if we do start to bounce up at some point, these gaps could really come into play. And looking negative, but bottoming right here is this at this S2 level with the Nasdaq. That could end up providing some support, but you can see the moving average is starting to come down to the longer term moving average. And we're negative with the Elder's impulse system for the Nasdaq. Also coming down to this S2 support level with the Nasdaq 100, but still negative with the Elder's impulse system. The momentum for the Nasdaq 100 is negative. We're negative with the small caps as measured by the S&P 600 and producing a recent death cross. Also, the Russell 2000 small caps getting extreme negative with the RSI, recent death cross. Momentum is negative. And negative with the small caps when looking at the Elder's impulse system might be a little hard to see because of the volume bars that are on here. And a recent death cross with the mid caps and breaking below this S1 support level. And negative down here where all the volume bars are. We're negative with the Elder's impulse system for the mid caps and dropping below the 200-day moving average of the financial sector. This had been a stronger area and an area that was giving us some hope. Now we're seeing some weakness here. It was down 7.33%. And we're getting further underneath the 200-day moving average with a bank ETF. The Wilshire further underneath its 200-day moving average. Also, the total U.S. stock ETF getting even further below its 200-day moving average. Same thing is true with the FANG index. That continues to show weakness. Apple was down 7.29%, and we are probably getting ready to see a death cross here as far as the trend. Amazon below its 200-day moving average, also seeing the 50-period moving average coming down closer to the 200. Microsoft has already been in a downtrend, down over 3.5%. Meta falling below its 200-day moving average, down over 5%. Google getting ready for a death cross here. It was down 3.4%. Nvidia, which is also in a downtrend now, down 7.33%. Tesla never did really get back above its 200-day moving average, and then it fell 10.42%. Netflix, probably one of the better looking charts, but it's even looking weak now. It was down 6.23%. And we're going back up here with this ratio. That means staples are outperforming tech. That's negative. That shows a market that's continuing to be more defensive. And we're seeing a stronger correlation here in the short term between US and world stocks because they're all going down together, and a little bit of an improvement with the long-term correlation. Oil really dropped. It was down 7.41%. We were in the low 70s. Now we're in the low 60s with oil. That's not inflationary there. We're continuing to see some weakness overall with the dollar, even though it bounced up just a little bit on Friday. And when we look at the 10-year yield, well, this is the 10-year based on price. It is actually going up, but we closed well off of the high. This is the 10-year yield, which continues to drop. We did get under 4% there for a while, but then we ended up bouncing up off of that going into the close. We're inverted with the 10 to the 3-month yield curve. And we're seeing a little bit of improvement here with discretionary to the S&P, but still weakness when we look at the Qs to S&P and large cap growth to large cap value. So the large caps, mid caps, seeing a little bit of an improvement with the small caps with those growth to value ratios. And I don't get to show this chart very often. This is when we use it like an oscillator. When we look at the mid caps and those stocks that are above their 50-period moving average, we're dropping below this red line. And we're seeing also an extreme negative reading with the small caps. And we're going down with this ratio, meaning the S&P is underperforming utilities. That's negative. And we're going up with the staples to S&P ratio. That's also negative. So what's our outlook for Monday? We are still negative in the short and intermediate term, but mixed in the long term. We're going to get consumer credit in Monday's session, and there's no economic reports coming out on Tuesday. And then anything geopolitical, but right now it mainly has to do with what's happening with the tariffs. So you could also put that in the geopolitical category. Here's the upcoming economic calendar where we're going to get the meeting minutes on Wednesday, and then CPI on Thursday and PPI on Friday. Also, there's another look at the economic calendar. Seasonality neutral to negative with Dow and S&P, and just flat out negative for the NASDAQ when we look at April 7th. And we do see some positive potential seasonality here in Monday's session. The green dashed line is going up for a few days, and even the solid lines are going up. And April tends to be positive, but so far it's been nothing but negative. And so on the negative side, our smart money indicators are now negative. Both the S&P and NYSE McClellan oscillators and summation indexes, they all drop below zero and they're all declining. Parabolic SAR is negative. We're turning over negative again with our oscillators for the S&P, as well as the other momentum oscillator, the Kopic curve. And then the bullish percent indexes, looking extreme negative here, but negative across the board. The swing trading oscillator is negative. The moving average studies, and a lot of those are getting extreme negative. The ease of movement, money flow, and the ultimate oscillator are negative. And the vortex is negative as well. And the long-term special K oscillator continues to be negative. And then the momentum for the NASDAQ 100 is now negative. Positive sign, we're still hanging on to uptrends with our growth to value ratios, but we're well underneath the 200-day moving average. So that could change at some point, and we've turned more negative in the short term. Financial sector, we're seeing some weakness there now with the bank ETF also still even further below its 200-day simple moving average. We did get a reversal signal with the mass index, and the Pring bottom fisher is generating a buy signal, but we have virtually no confirmation of that, at least yet. So our conclusion, we're negative in the short and intermediate term. We're still mixed in the long term. In both the short and intermediate term, we're negative but oversold. We have a pretty long list of extreme negative readings where we continue to be mixed with the long-term trend. Thank you. I hope you found this helpful. I hope you have a wonderful weekend, and I will talk to you in the next video.